G'day there guys, I'm going to try and quickly make a few videos rather than trying to type out long-winded answers on the forums, and hopefully that will be a more efficient way of actually communicating some basic ideas which sometimes can get quite convoluted and lost in text. Whereas a video can sometimes make things quite simple. I'm going to make things quite simple today by simply using my daughter's toys, using Duplo, in order to explain the concept of trust. Darren here has said, Darren Gill has said, "Hi Philip, this is Danny. Could you please explain and briefly interpret what trusts are again? I've learned different legal forms in entities yesterday in his finance seminar, but we didn't cover trust and I was quite confused with this concept." So I think that's quite a reasonable question here because trusts are oftentimes quite legally complex, and quite frankly our textbook and indeed most early year textbooks, or most textbooks, will just ignore trusts altogether, despite the fact that trusts form the vast majority of small businesses out there as their legal form. Now, trusts are actually based off deceased estates, and so I think it's worthwhile telling this story as if we're dealing with a deceased estate, and then we can more generalize this concept of what a trust is, so that you can see how it operates. But deceased estates is where things originally started at. So in our story here, we have 1, 2, 3 characters, and these 3 characters are essentially Grandma, who is the person who is going to pass away, because we are talking about deceased estate after all. We have a executor who is perhaps her brother or an uncle somehow, and we have a grandchild to Grandma who is essentially the beneficiary of the deceased estate. So let's set these 2 characters aside first, and we're just going to start off with Grandma. So Grandma is relatively wealthy. She happened to own her own pink little car. She owned this racy little second car, I guess. She owned her own house, and she also had a commercial property. So she's got significant assets under her own personal name. Now, when Grandma dies, she no longer legally exists, right? So because she legally can't go and front up before a judge in a courtroom, and she can't sign contracts and, you know, all the rest of it, all of Grandma's stuff obviously still exists. So who legally owns it? Well, the short answer is Grandma kind of owns it, but Grandma's dead and Grandma doesn't exist anymore. So what ends up happening is that her will specify who gets the estate, and that is all of the stuff. It's known as the corpus of the trust, or the body of the trust. That is all of the assets that are to be distributed. So Uncle here is named in Grandma's will as being the executor. He is essentially the trustee of the trust, and it's either the trust specifies that pretty much all the assets need to be transferred off to the granddaughter, and she inherits. She's down a grandmother, which sad. I hope I didn't break my kids' toys, but anyway, Grandma has passed away, and the grandchild now inherits all of these, but the executor is the person who is going to manage the estate for and on behalf of the beneficiary until such time as the trust distributes all of the assets to the beneficiary. So I just used a whole bunch of legal terms there, which were reflected in the lecture that we had this morning. But we can generalize these ideas by thinking about how the will might be adjusted. So if you have a deceased estate, and let's say that this child here is less than 18, so the will might actually say something like, Uncle, as the executor, as the trustee of all of this stuff, he legally owns the stuff, because remember, Grandma no longer legally exists. She's deceased, right? The uncle legally owns this stuff, and he will have to manage these until such time as the beneficiary becomes of full age, which traditionally used to be 21 years old, but it can be whatever the will says. Okay, so that trust, that deceased estate, let's say let's say she's only 1 year, so she's got like 20 years before she goes and inherits all this cash, right? Or, well, assets. So uncle here will have the power to manage these assets. So he's going to have to pay land tax on the properties. He's going to have to continuously not rent. What do you pay to the government? Registration fees is the word I'm looking for. He's going to have to pay registration fees for the vehicles. In fact, he might decide that really in 21 years' time, it's not in the beneficiary's interest to receive vehicles that are 21 years old. In fact, he might decide that it's in her best interest to sell these vehicles, turn them into cash, and then maybe buy another property or put them into shares or somehow invest that money some other way. But the important thing here is that we have somebody who started the trust, and that is the deceased grandmother. We have a trustee who is a legal person who is managing a set of assets for and on behalf of some beneficiary. Now, that trust can distribute income to the beneficiary, or it can distribute capital. This is not at all important for first year accounting. In fact, I promise you this will not be on the test. Like, nothing to do with trust will be on the test for first year accounting. However, it is important to understand that when you get to tax, that if you receive, say, a gift of capital, say, for example, here is a commercial property, and that the commercial property has been legally transferred from the trust into the beneficiary's name, then that is not income because it's capital. However, if the trust was to continue operating a shop, and the shop earns profits, and the profits are then distributed to the beneficiary, then the beneficiary will have to pay income tax because they're receiving profits, which are essentially income. So the whole income and capital split is really super important for taxation. It's not at all important for first year accounting, so I wouldn't worry about it too much. But what I'm trying to really point out to you here is the concept that a trust, which is managing a corpus or a set of assets here, is a legal relationship. And it's a relationship between the trustee and the beneficiary. This is not the same as a corporation. A corporation is its own legal entity. And the people who benefit from a corporation are directly owners of the corporation. So suppose that we have a corporation here that consists of a bunch of assets. Here we have the person who benefits from that company. They would be known as a shareholder, and that they can then vote in the directors who will then have the right to manage these assets on a day-to-day basis. And if the shareholders are particularly upset with the way that the directors are operating their the corporation, they can just get rid of them. They can fire them. They can vote them out. Okay, that is simply not the case with trusts. Okay, because it depends on what the trust deed says. Now, Grandma, let's bring her back from the dead. Hey. All right, so deceased grandma. I'm really tempted to deface my daughter's toys and draw little X's across her eyes, but I reckon my daughter will probably scream at me tomorrow morning, so I probably won't do that. So grandma here, when she set up her will, that is known as a trust deed. And in fact, grandma is able to establish a trust for and on behalf of a beneficiary here even before she dies. So there are two types of trusts. There are inter vivos trusts, or living trusts, that are set up without the death of somebody. And essentially the other type of trust is a deceased estate, which is, as I said, it's the more common sort of example which we imagine or it's where trust originally came from, or how they evolved legally. So when people set up small businesses, often what they'll do is they will then establish a trust, and no one has to necessarily die in order to establish a trust. So in the same way that you write a will, we'll just establish a trust deed. And we still get that same sort of relationship between whoever is the trustee and whoever is the beneficiary, where the trustee is managing things for and on behalf of the beneficiary. But unlike corporations, where the beneficiaries of the company, the shareholders, they have the power to tell the trustee what to do, trusts don't work like that, because the will, grandma's will specify what powers the executor or the trustee will have in order to dispose of or manage these assets, right? And it's quite common that beneficiaries have absolutely no legal right to instruct trustees on what to do. Now, there are a whole bunch of tax reasons why trusts are totally awesome, and you should totally learn more about them, despite the fact that universities don't teach them very much, and we really, really should. I'm not going to get into them because this video is already getting too long. But what I think is important to understand is that a corporation is a legal bucket, it's a legal entity, but trusts are a legal relationship, okay? We account for them as if they are an accounting entity, but legally, there is no legal entity called a trust. Suppose that this business is continuing to operate for the 20 years before the child can eventually grow up and then receive this shop, right? So this guy essentially then becomes shopkeeper of this shop, and he manages it for and on behalf of the young child until she reaches the age of 21. Then he has every power to make every single business decision here, and she can't just sort of walk in and say, I don't like the way that you're running the shop. He has every single right that is within the trust deed, and they have a relationship between the two, and if there is any problems that you need to go to court for, then he would turn up as the trustee, answering before the judge as to how he's managed the trust corpus. But again, he is not the same as operating as a sole entity, as a sole trader, because if he was operating as a sole trader, he would be doing it for his own behalf. But in this particular case, it's been very, very explicit that the trust is managed for a separate beneficiary, which is, I think, one of the major differences between a sole trader and a trust relationship. So that was a very short rundown on trusts. Trusts are awesome. Please learn more about them because they will help you reduce your tax and get really wealthy in the long run. They are not at all on the examination, and I hope that you enjoyed this video. If it helps you, maybe I'll make more videos like this rather than typing out long answers on the forums. We'll see how things go. Best of luck, guys. Happy studies.